One of my favorite comedians has always been Steve Martin. One of his funnier routines was called Let's Get Small. Now, lately, small company stocks in the US especially have been outperforming their large company counterparts by a lot, and it's hard not to notice. So today I thought we'd talk about what a small company is and why they might be outperforming those large companies. My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group in West Des Moines, and this is our financial perspectives for the 2 weeks ended April 11th. Before we look at the small cap stock story, let's take a look at 4 indicators that I think tell us how the economy and the market are doing. First, and always first these days, is talking about progress in fighting COVID-19, and that has to do a lot with the vaccination progress. Just 2 weeks ago, when we looked at this graph, the 7-day moving average for vaccinations was 2.5 million doses per day. Over the past 2 weeks, that 7-day average has risen to 3.0 million per day. If this rate stays the same, about 75% of the US population could be vaccinated in the next 3 months. That 75% level is one where people think herd immunity begins to set in, and we have a lot more chances of normal economic activity. All this is a net positive for markets and the economy. Talking about the jobs report, kind of our second indicator, new unemployment claims ticked up slightly last week to 744,000, but you can see from the chart that number has been relatively level. It's right around 700,000, give or take 50,000 per week. U.S. employers have added about 916,000 new jobs in March, and the unemployment rate fell from 6.2 to 6%. That's a net positive, but with this kind of sideways movement in total jobs growth, a little bit the same. Jobs numbers have been stuck in neutral for a few weeks. Continuing unemployment claims have continued to decline. But again, until we see this initial claims continue to go down, I would say jobs report are kind of in a neutral position. Here's a net positive. This is residential real estate, specifically kind of how people are dealing with housing. 2 weeks ago, we talked about supply and demand and increases in demand relative to supply, how that increased demand can cause prices to rise. Well, this week, we're going to talk about the supply side. And if we look at the chart on the left, you see how the supply of existing homes for sale is going down and going down pretty dramatically. That decrease in supply, coupled with this ongoing and increasing demand for homes, has caused the chart that we see on the right, where you can see that price spike on the far right side of the chart. Classic supply and demand, really not a negative yet. It's great if you're a seller, not so great if you're a buyer, but it's also going to be the kind of things that are encouraging a lot of new construction. That's going to be good for economic activity as well. Fourth indicator we'll look at is stock markets. They've been largely positive for the last number of months. That's also been true over the last couple of weeks. Stock markets are usually thought of as good leading indicators for economic activity. That's why I think this is generally a positive in terms of news for the economy as well. Technology shares have had a particularly good 2 weeks. That's the pink line on top. That's the NASDAQ, or the triple Q if you want to own an ETF, specializing in the 100 largest companies on the NASDAQ. They had a particularly good 2 weeks. They're up over 6.5%, kind of recovering from recent declines. If you look at the orange or yellowish line and the green line, those are stocks inside the US and stocks outside the US. Both did reasonably well in the last couple of weeks. The purple line is small company stocks, up 3.8% or a little bit more than that in the last 2 weeks. And we're going to talk about those small company stocks in just a minute. So what's up with small company stocks? I mean, since the bottom of the market last March, small companies have recovered, and in the past few months have really separated from large company stocks in terms of their stock market performance. Some of them have had 1-year returns over 100% through March 31st, even with the recent pullback. Now, the Russell 2000 and the Russell 2000 value are common benchmarks for small companies. But sometimes when we talk about the Russell 2000 or benchmarks, people go, that sounds interesting, but I'm not quite sure what you mean. So let me try to simplify it a little bit for us. If we think about the US stock market today, there are about 3,400 listed companies, meaning you can buy them on a public exchange relatively easily. And what Russell does, they're an investment company, and they also create indices of kind of stocks based on their size and some other factors. But the Russell 1000 represents the 1,000 largest companies in the United States that are publicly traded. The Russell 2000 represents basically stocks number 1001 through 3000 ranked by size. So in the bar chart on the left, The 1,023, that represents 1,000 companies, or 1,000, kind of the largest 1,000 in the US. The blue part of the chart represents those next 2,000 companies. So that's often called the small company part of the market. And then the yellow part at the bottom is something called the micro cap. So the really, really, really small companies in the US. But for our purposes today, let's think about the Russell 1,000, those 1,000 largest, the Russell 2,000, the next 2,000, which represents the small company market. Now, again, the bar chart on the left represents the numbers of companies. So 1,000 companies and 2,000 companies, you have 1/3 of the companies are large, 2/3 of the companies are small. If we look at that same kind of division of the market, those 1,000 largest companies, they represent 90% of the value of the US stock market. So the 1,000, the green, those 1,000 companies represent $42.9 trillion of market value, while these slightly over 2,000 companies represent 3.47 trillion. So you can see that in terms of market value, the Russell 1000, or those large company stocks, tend to dominate in terms of total size. And if we look here, you can kind of see, I think, maybe a little bit more recognizably why that might be the case. Think about the most common names in the public stock markets today: Apple, Microsoft, Facebook. Those are the three largest companies in the Russell 1000. That largest stock, Apple, is worth over $2.1 trillion as a company. If we look at the small company universe, the largest stock in the Russell 2000 starts at 18.2 billion. 2.1 trillion versus 18.2 billion. That's quite a spread in value. The average market cap for the average size of the company in the Russell 1000 is 420 billion. The average size of the company in the Russell 2000 is 3.67 billion. That's 114 times the size in terms of the average market cap in the large company market, that Russell 1000 average size, versus the average size in the Russell 2000. Dramatically different, which is why people tend to differentiate between large companies and small companies in the way they trade and what returns have done over time. Now, one other way to divide the market is, once you get into large companies and then small companies, so that 1,000 and 2,000, is to divide that same kind of set of stocks, those same universes, in terms of growth and value. The way Russell does this when we talk about value is they look at those companies. Let's talk about the Russell 2000. So those 2,000 companies, they take about 70% of those, and the way they sort down to that 70% is they look at kind of the cheapness, or which stocks are least expensive. And the way they measure which stocks are least expensive is they look at the price of the company relative to what you're getting in terms of book value, or what you're getting in terms of earnings. So price to book or price to earnings. The more that you're paying for book value, or the more that you're paying for earnings, the growthier the stock is, means it moves to the right on our chart here. But the less expensive that stock is. In other words, if I can buy more book, or if I can buy more earnings for less money, it's a value-ish stock. It's kind of on sale. And the further left you go, the deeper value kind of purchase you're making. Now, historically, kind of my blue box there at the lower left, that represents small value companies. Historically, small value companies have tended to be great performers for really patient investors. And let me show you what I mean by that. Small value, that deep value. I've got three market indices on the screen here. One is the FAMA French US Small Research Index, and that represents not just the 70% least expensive stocks, but it's like, imagine taking, I only want 30% or 35%. So I really want the lowest of the low price stocks in that small cap universe. The green down here, kind of the middle line, that's the Russell 2000 value. And then the bottom line represents the Russell 1000. That's its large company stocks. Now look at the outperformance in that FAMA French US Small Value Research Index. Everybody likes where the thing finished, big return. But the thing you want to look at along the way is the risk, the up and down that you had to endure to get there. Again, risk and return are still related. And when you're going after those higher returns associated with small value stocks, you have to be willing to put up with some pretty big volatility, at least in that part of your portfolio. A couple other ways to look at that. Let's look at small companies minus large companies in the US. So all this is doing is saying, on a year-by-year basis, going back to the 1920s, why has, or how much have small companies outperformed large? And what you can see here is The blue lines represent those years when small companies outperform. The red line represents the years when those small companies underperform. Going back to the 20s, small companies have outperformed by a little bit more than 3.5% on average per year. But what you can see is it doesn't happen every year. There are some periods of time there where, as a small company investor, you're consistently underperforming large companies. You're, at least that part of your portfolio is consistently underperforming the large companies, and sometimes by a lot. Same thing could be true of value minus growth. Again, over time, those value companies, the blue bars here represent the years when those value companies have tended to outperform their growth company counterparts. The red ones represent the years when value has underperformed growth. And if you look out here most recently, the far right-hand part of that chart, you can see that value has had a string of years here where it has been underperforming. So even though the long-term outperformance has been slightly over 4% on average, recently, if you're a value investor, you started to wonder, hey, is this really worth putting up with the risk, the underperformance, to try to get the longer term higher expected return of value? So what's the small value story? Well, it kind of makes sense. Small companies really are riskier as a group. And you think about that, if you were a bank and you were going to lend money, would you rather lend money to a big company like Apple with lots of revenue, lots of fixed assets, lots of success, lots of history, or a small company just starting out with a story? Most banks think that there's less risk in lending to Apple. It makes sense. Apple's probably going to be around for a while. It can endure some bad years. A small company, if you lend to them and they have 1 or 2 bad years in a row, they could go bankrupt and be out of business. They are a higher risk company. But the thing is, some small companies will grow to become very, very large companies. Apple started in a garage. Amazon started out of a garage in a warehouse shipping books. Jeff Bezos no longer does just books. He's become kind of a phenomenal success, starting with a small company to a much larger company. So there's room to grow with smaller stocks. That's one reason why they tend to outperform as a group over long periods of time. Value companies start off by being lower priced. You're buying something kind of at a bargain, a less expensive price. Now, it's likely that that lower price is for a reason. Something's going on currently that company, the market sees them as kind of out of favor. There's something wrong that needs to be fixed. But some value companies are going to recover, and the ones that do tend to outperform. And as a whole, over time, value companies have had a higher expected return than growth companies or the market in general. The point here is that risk and return are related. Small companies are riskier, value companies are riskier. If I combine small and value into a portfolio, I'm creating a fairly risky portfolio, albeit one that would have higher expected returns, but there's no guarantee that that's going to happen, which is why we just continue to encourage investors to hold a diversified portfolio. And if they want to try to increase their expected return, maybe overweighting those small and value companies slightly. One of my favorite writers, Jason Zweig, writing in last week's, he puts out an email called The Intelligent Investor. And he was looking at the last few months where we've seen this big outperformance in small and value. And basically what he's saying is, hey, don't get kind of duped into the idea that this is always going to be the case. We don't have to look back very far to see when it wasn't the case. He's making the point for diversification. His last sentence is really the one that I like the best. Diversification is insurance against our ignorance of the future. We didn't know what was going to happen in 2020. We really don't know what's going to happen in 21. And I don't think anybody knows what's going to happen in 2022 and beyond. So we want to be diversified investors, but we can look to history and some things like small and value and kind of the logic behind them to try to increase the chance of getting a higher expected return in our portfolio. Well, thanks for listening in today. We're glad that you attended. If you have any questions, you can contact us at any of the contact information here given on the screen. If you'd like to have an appointment with one of our advisors to talk about your specific financial situation, investments, financial planning, whatever it might be, we'd love that opportunity. You can contact us, have an appointment either virtually or in person. We'd be glad to get together. So thanks for joining. If you have any questions, please let us know what they are. We'd be glad to keep answering them. Until then, we'll see you in 2 weeks.